been, there are certain financial tips and tools that you have at your disposal all the time that will help you get through any crisis that you're about to experience or that you will in the future. Because what I know to be true is that this particular crisis, because of its scope, is different than what we normally experience in our lives. And there has been quicker and more access to funding. So things are a little bit different with this. I would say we're actually being looked after a little bit better than we would be if it was just a regular job loss or a regular illness that we were experiencing in our own lives. The scale of this has given us more support. So it's important, today we're not going to talk about that. A different topic, imagine that. Because change is going to come, and change is going to come, none of us saw this coming, but unless you were Bill Gates, but change is going to come throughout our working lives. And, it's important for us to be prepared for that. So the 5 things that I want to touch on today are, what does a healthy cash flow plan look like? And I'm going to be doing each of these points, both from an employer perspective, if you have people that rely on you for their income and businesses that you're running, and also from the employee perspective. So, and I would suggest, as a business owner myself, I wear both hats. I think about how I can take income from my business for my family, and I also think about running my business in a way that is sustainable for my clients, both now and in the future. So we will be looking at both perspectives. And again, deciding on, should I pay down debt or should I save? And that is always the question. I get asked that multiple times a week. So we'll touch on some things to consider for you in answering that question. We're also going to talk about group benefits. A lot of people with layoffs have been experiencing exactly what group benefits do and don't cover. So we're going to talk about that. Owning your own insurance, very important. And yes, even in these days of social distancing, you can still access your own insurance coverage without having to have a nurse visit. And the insurers have really stepped up there, and we'll talk about that. And last but not least, home equity. And I think that in this interest rate environment where rates are so low, using equity in a home to consolidate debt is a good idea, but I always say proceed with knowledge. It's not a catch-all, fix-all solution, and we'll talk about that in a little bit more detail. So those are the topics for today, so let's dive right in. So what are the characteristics of a healthy cash flow plan? Well, one of the things that I've noticed across the board with business owners and individual clients is that this time has forced us to look at our cash flow plan. And I'm really careful to use cash flow plan and not use the word budget, because budget implies something's happening to me that I can't control. It also implies scarcity. The reality is our cash flow plan, we are in control of to some degree. And maybe not on the income side right now, but certainly on the expense side, there's a lot available to us, always. So what I'm noticing from business owners is that this has been a great opportunity for them to review their expenses and identify where the excess is. And I was reading a great book I got over Christmas called Profit First, and it's for business owners talking about, when you were starting out and you had to justify every expense that you had as a business because you were uncertain what your cash flow on the revenue side was going to look like. It was like squeezing the last of the toothpaste out of the tube. You put your bristles in and you're sticking it around and you're making sure that, I've got enough to just get the job done. As businesses grow, what I find is your expenses tend to grow along with it. And it's like getting a fresh tube of toothpaste and you're putting it on you got way more than you need to get the job done. So now people are saying, if my business has grown and my expenses have been growing along with it, do I really need all of that? And they're doing that on the individual side as well as on the business side. Where can I trim the excess? So it's important to do that regularly, not just in times of change, but always to see, that you're honoring your cash flow and what's coming in and what's going out. And emergency savings, we talk about all the time for individuals, but business owners need to have that as well. So you need to have the same 3 to 6 months, depending on the nature of your business, of retained earnings in your account that you can quickly access. Because even if you qualify for a subsidy right now, most of those require you to first pay the expense and then wait for reimbursement. So if you don't have the cash flow there to pay the expense without taking out a loan, what are you going to do? And access to credit is key. It's important to have credit, not to use it unless you need to, but to get it before you need to use it. So making sure that, when you look at your overall cash flow plan, you've got an emergency savings, you've got access to credit, and you've also identified all your incoming and outflowing cash flow needs, and they all are necessary. From the employee perspective, when I do a cash flow plan, I want to see no more than 55% of the money that's going out of your home fixed. And by fixed, we always think of the mortgage, the heat and light, the car payments, but fixed can mean something different for everybody. And I don't like to discount the fact that if it's important to you to have a gym membership because of your overall commitment to wellness, then keep the gym membership. That would be a fixed expense. But we really challenge all of those fixed expenses to try and get it down to about 55% of your overall cash flow. And then 25% is your fun money. It's your mad money. Now, when I say fun money, that does include your groceries and it does include your gas, because you do have some control over how and what you eat and how much, you spend on gas and those types of things, depending on, travel. Then the 20% left over can't all be about the long-term goal. If you've got the extra 20% of your cash flow only going to retirement savings and your retirement is still 20 years off, I would suggest you're going to abandon ship before you get there. We need to have a little short-term goal built into that 20% as well to keep us engaged and to keep us motivated. Whether that's, a purchase, whether that's a trip, whether that's getting a credit card paid off in the next 18 months, there has to be short-term and long-term goals with that additional 20% once we've identified our fixed and our fluid expenses. And I like to divide to conquer. So make sure that your fixed expenses are in an account that you don't easily access, and have all the fluid stuff in an account that you use your bank card with. So again, if it's all in the one account, it's much harder to keep track of what's what. So I think everybody should have at least 2 accounts, one for fixed and fluid expenses and the other, or fixed and the short and long-term goals, and then the 25% is what you can access every day that you need to. All right, so to pay off debt or to save, that is always the question. So from an employer perspective, there's a lot to think about, and this does get more complex depending on how your business is structured. If you're incorporated, if you're a partnership, if you have a holding company or just your own corporation, but it's always the same as what it would be for an individual, I'd suggest. And that is balancing your need for liquidity, so that emergency savings, that ability to have some cash for a rainy day, with the investment risk and the investment opportunity. So trying to decide, what is more important right now. And as a business owner, the government has, effective this year, they've changed a lot of the rules around what you can earn on investments within your company if those earnings are considered passive. So when we think passive, we think, interest income, passive rental income, dividend paying portfolios, the taxable portion of any capital gains you may incur in a year. Those amounts, once you've exceeded $50,000 in passive income in any one tax year, then every $5 above that reduces your small business deduction by $1. So what that means is you could find yourself, instead of paying at the lowest corporate tax rate, being taxed at the highest corporate tax rate. So it's really important to honor that and be aware of that. And that's a conversation, that you can have with your advisor and with your accountant. And not all investments as a business owner or as an individual are treated the same from a tax point of view. There are tax deferred investment opportunities. There are, capital gains exemptions that you can take advantage of. Similar to, as an individual investor, when you're looking at, okay, I've decided that investing is something that I want to do with some of my cash flow, but do I do that as an RSP or do I do that as a tax-free savings account? Well, business owners have similar type of decisions to make with their corporate money in terms of, how do I invest to realize tax benefits both in the short and the long term? So it's important, when you're making that decision, those are the things you have to weigh out. So what you're probably going to get from this conversation today, guys, is that there's no one size fits all answer. So these are, tips and tricks to weigh out the pros and cons of each decision you make. But it's important to always start with, where am I today and what do I have to work with? And I think we quickly sometimes jump into these debt or savings decisions without really having looked at our picture. I'll give you an example on the employee perspective. It's important to know your numbers first. And it's always surprising to me. And when I sit with a client to look at their cash flow plan, when I see clients that are happy to tell me that they're contributing regularly to a tax-free savings account or an RSP, at the same time, when we do their cash flow, we realize that they're spending 120% of every dollar they're bringing in. So they're overspending, and most of that overspending is appearing on a line of credit or a credit card. So if you're paying interest at 20%, and maybe you've got your tax-free savings in a high interest savings account earning 1.2%, have you really improved your overall net worth? I would suggest you probably haven't, but people have been told I should be saving in a tax-free or I should be putting money in an RSP. And they haven't stopped to say, but does that make sense for me right now? So the time today, does that make sense for me right now? So to stop and see the money in and the money out, knowing your numbers first, I can't stress enough, it's so, so important. Doing that heavy lifting, I call it, to put together a cash flow plan. And what I'm going to do is send out after this, when we send out the survey, is just a template that we use in our office to help people walk through their cash flow plan. Because I think it really serves as an eye-opener. As painful as it can be, sometimes it's a pleasantly surprising thing. At the end, you're like, okay, I am not overspending, or I'm in control now of one of my short-term goals being stopping the tax-free savings and addressing my debt issue and redirecting those funds. So you're able to make choices instead of feeling like your choices are being taken away from you, which budgets often make you feel like. So, you know, it's all about how you look at it. And choosing. Right now, a lot of people this year are probably not going to be earning the same level of income that they were in 2019. If they have this period of, you know, temporary layoff or cutback in their hours, this year their need for an RSP contribution may not be as high as it will be in years where their earnings are going to be higher and that tax break is more beneficial to them. So maybe you redirect from the RSP to the tax-free this year, or you take advantage of a interest-free period on a loan to address that and get that dealt with. I would suggest that paying down debt will equally improve your net worth and your flexibility as having money put aside in a savings plan. So, you know, big picture, always about the big picture, but you got to get in the weeds to see the big picture. Group benefits. All right. Group benefits, I always say nice work if you can get it. Group benefits are wonderful. I help employers put group benefits in place for their employees all the time. But what I've learned from an employer perspective over the years is that if you're going to offer a group plan to people, you have to make sure that you haven't only taken care of them today, but you factored in what will happen if at some point down the road, we can no longer offer this group plan. And we're seeing that in smaller groups where you might have an employee or two or a family member of an employee that's covered that has a health crisis and starts to put in a lot of claims. Now, when the plan comes up for renewal in 12 to 15 months time, you know, the company looks and says, we collected this much in premiums from your employees, but we've paid out twice that in claims. Well, these insurance companies are in business to make a profit, like every business owner on this call is in business to make a profit. They have to figure out what are we going to do to continue to offer the plan. And oftentimes that means cutting benefits or increasing the premiums for the next year. Sometimes it means we can no longer afford to keep this group plan. And when that happens, if you've relied as an individual on having access to that group plan for all your insurance needs, be it your life insurance, your health care, your disability, and now it's gone overnight, where does that leave you and your family? So there is a product, and this is the only plug I'm going to put in today because I truly feel everybody needs this particular product. But Medicaid Blue Cross offers a product called Assured Access. And Assured Access, I tell all my employers that have group plans in place, let's get Assured Access in place for your employees as well. Regardless of where your group benefits are held, it could be with any insurance company out there. As long as there's group coverage in place, your individual employees can access this product that takes a snapshot of their health today. And not only their health, but their health of their family members. And what it does is says, at some point in the future, if either the group plan goes away, or I as the employee decide to leave, then I can flick a switch and access my own private health plan, and nobody's going to ask if there's been any changes to my health since that snapshot was taken. And that's super powerful. I especially see it with retirees who have had group benefits for an entire career through a company. They've never had to answer medical questions because all they had to do was work for the required 3-month probationary period, and they rolled on the group plan. And now they've had this drug card that their family's been going and getting prescriptions filled, and the occasional massage, and their glasses, and their dental trips. And now they're retiring. Chances are at 60, 65, their health is not better than it was when they started working with that company 20 years ago. And they probably do have a few pre-existing conditions now. And now they've been told, you're retired, you no longer have access to this coverage. Well, now you end up going to an advisor like myself and saying, I'd like to get a health plan and I'm happy to help you, but everything that you currently have prescriptions for will not be covered on this plan. So now you're going to be paying premiums for a plan that doesn't cover what you need the plan to cover. So you'll be paying those premiums for the what ifs, and you'll be paying for the prescriptions out of pocket. And oh, by the way, you're retired and you're making a lot less money than you were when you were working. You know, not a great conversation. Those are not fun meetings in my office, I will tell you. But that same employee whose employer had said, we're going to get you a short access when you're healthy and don't have any existing issues, will walk in the office and say, I have a short access. And I say, okay, what would you like? And it's almost like a menu. We pick and choose your health options, your dental options, and you flick a switch. The first of the following month, you're now covered and your family's covered and no questions have been asked. An entirely different conversation and an entirely different outcome. So it's really important. You know, and I don't want to belabor that, but it's something I think it's worth everybody on this call looking into for your family. I've had it for years, and I am married to a teacher who right now, the government tells us we'll continue to have access to group benefits in retirement. But we all know that when collective agreements come up, things change. I don't like to have anyone else control my destiny, thank you very much. And I don't think anybody on this call would like that either. One of the things that your employers on this call should know is that if you do have group benefits and you have had to lay people off, a lot of plans are allowing you to keep your employees on the group for up to 60 days. You can decide how you're going to carve that up in terms of who pays for what. But if you're really, you know, committed to keeping your employees ready to come back full time when restrictions are lifted, you know, maybe that's something that's worth paying for, is keeping them on the group coverage. And if you can't offer a group benefit, or you've offered one and you're deciding I can't do that anymore, a private health spending plan is a wonderful alternative. And with that, you can say, I'm going to give each employee a $500 annual amount, for example, and the amounts will be set based on their income and the company's, you know, overall revenue. But we can set different classes of employees, give them a health spending allowance, if you will. They can spend that however they want to or need to on healthcare, from everything from braces for their teenager to, you know, physiotherapy if they need it for a spouse. The company writes that off 100%, and the employee receives that benefit 100% tax-free. So it's a wonderful little trick that business owners can use to still show I'm committed to you as my employee, but right now I'm trying to contain the cost of being able to offer you some form of healthcare. Fantastic, fantastic little nugget that Revenue Canada allows business owners to do. I think I've already touched on this, but as an employee, always have a plan B. Do not have your employer control all your outcomes. And if you have been laid off, maybe now your employer doesn't know about the temporary layoff provision, but you do. So you can say, listen, can you keep me on your group plan for 60 days? Ask your insurance company if maybe that's something we can work out. Or if you think the layoff is permanent, some people are taking early retirements through this, for example, and you have pre-existing conditions, so you will find it very difficult to find a private plan, then look at the policy's conversion options. And that means you can roll off of the group plan into an individual plan without, again, having to answer any medical questions. The difference between that, however, and the assured access example I used is that those plans, number one, tend to be more expensive because that insurance company is taking you on and they've never gotten any indication of what your health is like. So they have to, you know, price that into their plans. The second thing is they're going to cap the benefits because they can't give you unlimited drug coverage, for example, if they don't have any idea what your health situation is like or the members of your family that may be covered by that plan. So it's not it's not out of the ordinary for us to see converted group benefits plans that have been turned into individual plans only offer $1,000 a year for the entire family for a prescription. So, they're restrictive, they're expensive, but again, if you find yourself with no choices, it may be worth looking at. So treat your group benefits as a nice to have, not a be all end all. And that's, a Newfoundlander saying, I don't know, but it's not the be all end all. It's nice to have. Even when I am talking about life insurance, people say, well, I have life insurance through work. Again, no one has ever gotten more of a death benefit when they've lost a loved one and said, God, I wish I didn't have that extra 2 times salary. Usually they're looking for more insurance than what they have. So it's nice to have, but it's not the be all end all. Which leads me right into owning your own insurance. So really important, if you are a business owner, and I know it's very popular with advisors to say to business owners, you can have your company own your insurance. You can have your company pay your premiums. For some reason, it's often easier for a business owner to write a check out of the company account than out of their own personal account. And, any business owners on the call probably, yeah, I can relate to that, because you feel like you're getting something for nothing by having the company pay for it. What I know to be true is that that's a great idea if the purpose of the insurance is to protect the business and the business needs. If, however, the purpose of the insurance is to take care of a surviving spouse and dependents, do not have the company own that coverage. Because what will happen is, yes, if you passed away, the company, your company, paid your premiums the whole time that policy was in force, and the company has to be the beneficiary in order for that to remain on side with Revenue Canada. The insurance can flow through the company on a tax-free basis, but once it gets into the company, it's no longer creditor-proof like personally owned insurance would be. So if you pass away and there's a bunch of creditors that are looking for, bills to be paid, they don't care that there's a widow and children that are waiting for the proceeds of that insurance to keep a roof over their head. And oftentimes what I've seen is that by the time the insurance gets through the company, and shareholders are compensated and creditors are compensated, that what you intended to have for your family is not at all what they receive. So again, great for business purposes if you want to make sure that a shareholder or a business partner is going to be looked after and can be properly compensated and your family can get the value of your shares back. There's a planning opportunity there, but not for personal needs. For your personal needs, own your insurance personally. One way that you can get your company to pay premiums, though, and protect you personally is with a wage loss replacement plan. So if there's at least 2 executives in a company, then you can set up, already as a business owner, that your ability to access short-term income protection through the employment insurance program is limited, if non-existent. So what I find employers saying is, what if I'm not able to work due to an injury or an illness? What's that going to mean to my family's bottom line? A wage loss replacement plan is to a business owner what a long-term disability plan is to an employee. It will replace your income for a period of time based on a waiting period and based on the definition of what it means to be disabled. And as long as the company included the premiums as part of your taxable benefits each year, then when you receive those benefits, they can still be tax-free. So there's a way to structure that so that your company can pay for your income protection and you can still maintain the best benefits from that plan if you're ever unable to work. From an employee perspective, anybody that's had a conversation with me has heard me say you don't control what you don't own. So again, when it comes to owning your insurance, having your insurance with an employer, I think we've talked about in the last slide, but also having your insurance with a lender. So, a lot of times people will come in and they say, I've heard it's not a good idea for me to have my mortgage insurance with my bank. Can you tell me more about that? And first, I'll always reiterate, absolutely, it's not a good idea to have your mortgage insurance with your bank. And for a host of reasons. Right now, I'm seeing a lot of people wanting to, consolidate their debts. If their mortgages are coming up for renewal, or even if they're not, they're looking to take advantage of low interest rate environments to try and use equity in their home to, roll all their debts into one convenient and lower payment. Well, if part of that shopping around for options means you're moving to a different lender, you may not be able to take that mortgage insurance with you. it's tied to that lender. Whereas if you had your own private insurance plan, then that has nothing to do with the lender, and you can shop around to your heart's content. No one is going to take that policy from you. The two things are separate and from each other, which is the way I like to have it. I control my insurance and I can choose which lender I'm going to put my mortgage with. So that's first and foremost, is the flexibility it provides. Second of all is the flexibility it provides around who you name as your beneficiary. On a mortgage insurance plan that's held through a lender, the beneficiary is always the lender. So at the end of the day, if one of the two people, let's say, that own the home passes away, the bank gets their money, and so they should if you've been paying the premiums on that, and you do owe that to them. But you may have a spouse that's now left with a house that they don't have a mortgage on, but they have no other insurance proceeds to keep the lights on, put groceries in the fridge, keep the kids in daycare, to continue to make the car payments. Having the mortgage paid off is only part of the equation. So, if all you have is your insurance through the bank, you're in a mortgage-free home that you may not be able to afford at the end of the day, even with it paid off. So it's important to look at the big picture. The other thing I like is that insurance companies are still allowing you to get access to insurance, even in these days of social distancing. So I work with, as a financial planner and financial advisor, I work with about 18 different insurance and investment companies. So I broker. I don't work for any one company. I work for my clients. So I will shop around and I will find the best solution once we've identified what the need or what the goal is that we're trying to achieve. And I've been really embracing technology for a number of years. And that's serving my clients and my practice quite well now, because I've been doing electronic applications for a number of years. So we don't have to meet. We can do a Zoom meeting. I use GoToWebinar. We can do an application on the screen. We can use secure document signing technology for you to sign off and accept that. And today I'm doing an electronic delivery of an income protection policy with a business owner. So we will review the policy, sign off, and deliver, and everything is good to go. So there's technology that's been around long before this crisis and will continue to only evolve and get better. But there's also built into those applications algorithms that, depending on the answers we provide, will oftentimes make it unnecessary for any more information. They may not need to have a blood or a urine sample. They may not need a doctor's report. By doing the electronic application and harnessing the power of the technology, we're often able to get an answer and a contract in place much sooner. The other thing that most companies have said now is, even if normally we would require fluids, we are going to allow you to get, in some cases, up to $2 million of life insurance, up to $250,000 of critical illness insurance, and up to $8,000 a month of disability protection without you having to provide any fluids or have a nurse come to visit you. So they've really stepped up, and I'm really impressed that my industry has done such a great job of responding to this, so that people can still get what they need when they need it and not put themselves in harm's way. The other thing to keep in mind when you're looking at owning your own insurance is making sure that you address all your needs. And one of my pet peeves in the industry is when I sit with a family who says, yes, we have some insurance in place, and it's this robust whole life policy with cash value and paid up in 20 years, and it's wonderful. And it's costing them, pretty much all their insurance budget, and the death benefit is about $50,000. But I owe $300,000 on a house. I still have 2 kids to put through university. We've got $20,000 on the line of credit, from a renovation that we did last year. All this, where's that $50,000 going to be at the end of the day? So, it's going to be a drop in the bucket. So not only should you have all your risks covered, but you also need to make sure that you have the right amount and the right type of coverage. So while there is a place in every financial plan for some permanent insurance, like a whole life policy, I wouldn't give my whole budget to a small whole life policy and ignore all the other risks that I'm much more likely to encounter over the next few years. If you are between 30 and 50, you're about 3 times more likely to have a critical illness or a disability than you are to die in the next 20 years. So, keep your life insurance needs appropriate for what the risk is. And don't discount the need to have some critical illness and some income protection in place, because that's really, what your risks are going to be in the short term. If you are over 65 and you're retired, then some permanent insurance makes a lot of sense. And yes, the sooner you can build that into your plan, the cheaper it's going to be and the more options it's going to give you. But it's always about big picture, and then we dig into the weeds. So owning your insurance and making sure that you balance all those needs out is super, super important. All right, we got about 8 minutes to go, and we're at our last slide, so I'm excited. Home equity, just a word of caution. Another pet peeve of mine in the industry is when people have a consumer debt, I'll call it. It's unsecured. So something like a credit card balance or a line of credit balance, and the interest rates have started to creep up. They feel like they're making payments, but they're not really getting ahead on getting that debt dealt with and paid off once and for all. So yes, my mortgage is up for renewal and rates are really low. I'm going to consolidate that and get it done. Well, you and I know it really didn't go away. The debt is still there. It's just been absorbed into the mortgage debt. Now, if you're going to pay that debt off in the 15 to 20 to 25 years left on your mortgage, when we run the math, you actually haven't saved any interest than if you kept it at the 20% credit card rate and paid it off in 18 months or 24 months. By stretching it out, for the longer amortization period, you'll still end up paying the same amount of interest on that money as you would have by keeping it elsewhere. So what you can do, though, is still absorb it into the mortgage, but you can set up your own sub account, I would call it. And some of the banks do offer this. I know Manulife Bank has a great product that does, I guess that's my second plug of the day, but a great product that does, allow you to consolidate debt and then break that up into smaller chunks, because we know we eat an elephant one bite at a time. So if this is something I would have paid off outside of my mortgage in 2 years, then I can consolidate it in the mortgage to take advantage of that lower interest rate, but I can still set it up on a 2-year payment. More of my payment is going to the to the principal and less to interest, but it's still not, it's actually really going to be gone, not just out of sight, out of mind by having it absorbed in the mortgage. So it's important to keep those original repayment timelines intact to really realize the benefits of a home consolidation. And qualify when you can, not when you have to. Thankfully, a lot of lenders have announced that if you can provide a letter saying that this is a temporary layoff and you have a return to work promise from your employer, they will still use your income that you had pre-COVID-19 to qualify you for a mortgage renewal or a refinance. But the reality is, again, as I said at the beginning, this is a global scale pandemic, so things are different than usual. Typically, if you've been laid off and you go to an employer, they're not going to say, oh, great, you're planning to get back to work in 6 months. Yeah, we'll use that promise and that hope of employment to qualify you for the mortgage. Chances are they're going to say, sorry, when you get back to work, come talk to us. So qualifying, once you've had, if you're self-employed or a new business owner, once you've had 2 years of consistent income that you can demonstrate to the lender, and you have at least 20% equity in a home, go and get that home equity line put in place, even if you don't need it. Keep it out of reach and out of temptation's way, but at least it's there for a time when you may need it. To avoid penalties, obviously, it's always best to do that when your term is up for renewal. Banks and lenders will charge you usually 3 months interest adjustment if you do it prior to the renewal. But again, it comes down to, will I save more interest on my other debts by doing it now and absorbing this 3-month penalty, or can I afford to wait until my renewal is up and avoid that penalty? So again, we weigh that out, pros and cons. Never base these decisions on fear, but try to base them on the facts. And sometimes that just means just take a deep breath, see where we are before we run to, to a solution because our neighbor told us it was a good idea. And some lenders will waive appraisal and legal fees, and don't let them tell you they won't. So if you're looking at moving, they really want your business, and you can tell them that Manulife Bank will waive my legal and appraisal fees and use that as a bargaining chip when you go to say, I want to give you my mortgage business, and I also want to give you this other, debt that I'm going to roll into it. But at the end of the day, I don't want to pay $2,500 if I don't need to. So what do you think about that, Mr. Lender? And, usually you can negotiate those things, But if you don't ask the question, the answer is always no. So ask the question. And, again, talking to an advisor before you go in to have those conversations, you can go in prepared and nobody is going to, get one over on you because you've got the facts and you know what you're talking about. So that is it with 4 minutes to spare. Those were my 5, best tips. And again, there's so much on each one of those slides. And I apologize if you feel like you've been drinking your coffee from a fire hose this morning. I tried my best to limit it down. If you want to talk to me about any of these things, I've got my information up on the screen. As you can probably tell, I get very excited and passionate about these topics because I think there's so much opportunity for people to, be prepared when disruption happens and to take advantage of, things instead of feeling like they're backed in a corner. So I'm really excited that I had the opportunity. I'd like to thank the Chamber for making this possible today. And if there's any questions, fire away.
I noticed there, Shelley has a question there, Jackie. Is it assured, about the assured, is it assured access or?
Yeah, the policy is called Assured Access.
Maybe I can get a link or something to that.
Yeah, I can totally send you a link to that. And just so you know, like for us, we're a family of 4, and we've had Assured Access. My monthly premium for that peace of mind is about $40 a month for a family of 4. And my oldest child is graduating from high school next year. In a couple of years' time, depending on what he decides to do with his post-secondary career, he will be kicked off the group plan. He's no longer dependent, and it gives me such peace of mind, even though thankfully he's a healthy boy, to know that when he's kicked off our plan, he can roll onto his own plan, no questions asked. So, it's a wonderful, inexpensive, groundbreaking solution that everybody needs.
And there were a couple of other things that you mentioned, Jackie, and we will send those out. We'll send it out in the whole email with like the resources that you mentioned and the cash flow template you mentioned as well.
Absolutely.
We'll send that out. Awesome. Any other questions, anybody?
Hi, Jackie. I just want to say that was great. I was listening along, and I can agree with all points from CBDC clients. But it's good to know you can sort of break it down, and I think the stress sometimes is everything seems so monumental that people don't want to touch it in terms of cash flows and things.
Absolutely. I've had clients say to me that have done their cash flow, at least in the short term, that they're fluid spending, that just, and even some of the fixed expenses around activities and gym memberships and things like that, that their cash flow savings is actually, on the expense side, down anywhere from 40 to 60% of what it normally is. So what a great opportunity with that having, dropped off, and you don't know it till you do the math and you take stock of where you are, to redirect that if you are carrying some debt. I mean, you can come out of this thing better than you went into it, I would suggest, in some situations, because we do know a lot of people are still working, some longer hours than others.
Yeah, it's almost like a reset, a forced reset for a lot of people, which is good.
Yeah, that's absolutely what it is, Margot. And it's, see it for what it is.
I'm
Not
curious
a crisis,
if you've
an opportunity.
I'm curious if you've seen a crossover, like there's been a lot of folks that have for the first time ever reached out to EAP services, and it seems like wellness and mindfulness, I don't know if there's a correlation between stress about finances or whatnot, but it's the first time I've noticed there's a huge uptake in exploring those types of programs. So I don't know if you've seen it on your end or if there's
I see it a lot on the underwriting side of things. So underwriting is just a fancy word for, when an insurance company is assessing a person's insurability and looking at, lifestyle, health, family history, those types of things. I am seeing they're very cautious around for income protection policies and disability policies. If there's any history of mental health in the past, they're really digging deep into that, because right now, claims for mental health on income protection plans has actually trumped claims for cancer and heart-related illnesses. So they know that and because it's, something that people are more comfortable talking about, as they should be. We're hearing more and more people are, not suffering in silence. They're going to their doctors. They're getting referrals to psychologists. They're, looking at medical or prescription medication that they can take. So that's appearing more, and insurers still don't really know what to do with that in terms of the liability that it provides to them on an income protection plan. So, I'm working through those cases every day.
Awesome. So I guess that might be it, Jackie. I think that what we can do is take this recording and I'll remove everyone's images, and then we can put this out so people can watch the replay, because it was a great overview. Yeah.
Thank you.
Awesome.
All right. Well, thanks everybody for taking time to chat this morning. It was great to see some familiar faces. Hi, Jill. And yeah, no, it's really, really good. And any opportunity I can do to connect with folks and offer some help, I'm happy to do that. Guys, enjoy your day.
Thanks so much.
Bye.
Right.
Bye.